All right. Good morning, everybody. Let's see. It was kind of muted in the overnight hours through the Asian session. The last time I had looked at the market last night, it was before Asia had opened, but Australia had already been open for a while and they were in the green. Just kind of taking a look around. Oftentimes, you'll see in the overnight hours, they will say something like the Asian markets were down today, X amount, up by X amount, and they'll give you some guidance on which sectors moved the Asian markets up or moved them down. They'll also often give you a hint on what the European markets are doing and what is moving them up or down this morning. It's always the chicken and egg argument, which happened first. Did we give them, a boost and it carried through the day, or did they begin a catalyst move and are going to give us a boost through the day? We've got a lot of events on the table today. It is a full house, what I call a data dump. We're also talking about the dollar again yesterday. I want to stress this. The dollar by itself, just looking at the chart, doesn't give you enough information. We have to understand why the dollar is moving. There are times when the dollar going up is really good for the stock market. And there's times when the dollar going up is really bad for the stock market. And we're only talking about looking at it at that particular day and asking, is this good or bad? I'm not talking about, economic logic and economic theory and being a basement economist and a strong dollar versus a weak dollar. That's not a part of the discussion. It's only looking at the chart right now and asking, why is the dollar bidding up or why is it bidding down? Right? Why is it getting hammered to the downside? And what's that going to do for the S&P and the NASDAQ today? Not the big picture stuff. A lot of that context comes from understanding the current move in the dollar. A great example of this is last year, Asia really cracked down on its rich citizens and was mandating how they could participate in the Asian market. The solution that they came up with was screw the Asian market. We'll go put our money in the American market. They had to get into our American market through the US dollar. Right. So they were doing FX foreign market currency exchanges. They were bidding into the dollar. We seen the dollar bid up. And then we seen a lot of tech and a lot of those blue chip companies bidding up in the month after that or during that whole entire phase. So it was a strong dollar, quote. That doesn't really fit into what we're discussing, but it was a dollar that kept going up every day. And that participation in the dollar was also then participating in tech and those blue chip companies. So seeing the dollar go up during that time period was a good thing. It kept showing that overseas involvement. The entire situation was a positive situation. You take the current market environment where uh, there's really no safe place to hide. Bonds are getting beat down. Stocks are getting beat down. These firms don't want to go to cash because they're going to pay a really big fee or a fine. They got to put their money somewhere, and they're going into the dollar, and we're seeing the dollar bid up. That's a completely different situation. So now you got the dollar going up. We can't look at it the same way that we looked at it last time and think, oh, well, that's positive. They're getting into the dollar so that they can get into our markets. No, they're getting into the dollar because they don't want to go to cash and they got to get into something. And our junk is better than somebody else's junk. That's it. Right. But we have to have that context behind it. Why is the dollar going up or why is it going down? Where the one of the places that I get that context is on FX Street. They usually have a little excerpt here up at the top that talks about the dollar. Bloomberg often has articles, Wall Street Journal, TD Ameritrade, Schwab, Fidelity. Just look around and see if you can find an article that covers what's going on in the dollar right now or recently in the last few days. Because you got to remember what we see in the dollar or what we see in the market really. It's not just happening in one day. When you're moving millions and millions of dollars, it takes days to get those positions built out. We have a lot on the table today, and you can see that there's a lot of these with really high impact expectations. To dig a little deeper into what those are, to me, it's easier just to come over to Thinkorswim. This is much cleaner. I grasp the logic here. It's just simple and easy. 7:45, 8:30, 10 o'clock, 10:30, 11, and 11:30. I can't stress enough, guys. It's going to be one of those days. Additional auctions at 11 and 11:30. These are game changers. No, that's a misunderstanding. We're not actually trading the US dollar or even watching the actual US dollar. This is an aggregate. It's got the euro in it. In fact, it's got more euro than American, but we're using this as a proxy, as a gauge on what actually is happening in the dollar, right? So, um, and going to cash is actually going to cash. It means that they're cashing out of positions and they are either raising cash on the side and prepping with this pool of money to do something, or they're not raising cash, but instead are going to cash, exiting positions without entering into new positions and having a cash pool ready to go. Both of those statements that use the word cash are still talking about not being in a market and having capital on hand as opposed to the dollar. But this is not the US dollar. This is an aggregate, a proxy symbol. And while you'll hear me and everybody else refer to it as the dollar, it's not like the American dollar. It's not that. I think the American dollar right now is at around 120 something. At least it was the other day. Good question though. It's a really good question. Market watch, guys, be very careful. It's a long weekend, big data dump, a lot of information. It's almost set in stone at this point that we're going to be seeing those 50-point rate hikes, and the market seems to believe the Fed can do this soft landing. It's been done before 3 different times. Um, and even if we were to go into a recession, the recession cycles are getting smaller and smaller. I don't know if that's because of how much the algos participate in it now and really bring us up out of the other side of it. Just keep in mind that rate hikes is where we see the market go up. Anticipating rate hikes, the market goes down, it sells off. It's trying to price in those hikes. But when they actually start raising rates, the market goes up, guys. So it's not a bad thing, it's a good thing, right? It's going to bring us up out of these lows, but they're not planning to start yet, right? It's like May, I believe, maybe March. Maybe we'll get a 50 in March and then another in May. I don't know. I don't want to get into it and start speculating on when it's going to be. But go back and look when they actually are raising rates, the market goes up, right? So, you know, don't fear the reaper. All right, so we had a trend line breakover in the S&P. Here we are on a 130-minute chart, and you can see the trend line breakover from yesterday. After we got above it, we've just been kind of stagnating a little bit, kind of holding the line. There is the 10-day point of control that we're going to get to when we look at the volume profile. But for the most part, just kind of want to zoom in and approach this the same way that we do every day, kind of asking the question, what's our expectation today? Well, there's three things the market can do. Can maintain this sideways range. We can break out of yesterday's range and make a move to the upside, and or we could break out of the lows of the range and make a move to the downside. That's always the three things that we can do, right? That's what's on the books. If you look at yesterday's range, we're basically sitting at the top of that range, right? We even poked our head outside of the top of that range and then we came back inside. So if we're looking at leaving yesterday's range, having an inside day breakout, it's much more likely that we're going to break out of the top than break out of the bottom, right? So when we look at it from that point of view, kind of asking that question, what's more likely that we break below 43.80 and head to the downside, or that we break above 44.50 and head to the upside? I'd say a topside breakout's much more likely than a bottom side breakout. But we could revisit the lows of the range without breaking out of the bottom of the range, and that would be much more likely, right? So if we look at those three scenarios and we say that a downside breakout of yesterday's range is the least likely situation, we just set that one aside and say, all right, well, what's left? That we could visit the lows of the range and or that we could break out of the top. Great. Now that's where we want to spend a lot more of our analysis. So from that point of view, we then want to ask the question, what's on how far could we go? Our average daily move right now. If you don't have ADR, you could just as easily use ATR, average true range, average daily range. Really, the only difference is their smoothing technique. Um, Me personally, I like the ADR because it's much more straightforward. It doesn't use any weights in the front. ADR is really simple, just asking how many days are we going back. For me, I use 21 days. Uh, 20 days is one market month, and 21 brings us, like into the current day. So you always have that one day that's dropping off when you do an average. So we're looking at the last 20 days from the highest point to the lowest point and asking how far did it move on a day-to-day basis. We get that average. Right now, the average is 1.5. The ES has an ADR of 1.5%. It's been decreasing for the last month. We were at like 2.25 for a while, and we're now down to 1.5. Each day that goes by, if we continue to get these smaller and smaller days, we're going to continue to see a smaller and smaller ADR. But for today, we're basically flat. We're not up. We're not down. We're nowhere, right? We're exactly where we were more than 12 hours ago when we opened in Globex. We haven't done anything. Now we could make a 1.5% move starting right now. And with all the econ on deck, I don't think that that's out of line at all. But it will be a very fast move. It'll be very extreme because if the average daily range is 1.5, it's calculating a full 22-hour day, and it's saying from Globex open all the way until 4 o'clock the next day, the average range is about 1.5%. Well, half the day is done already. So we're looking at from right now until the end of the day. Could we make a 1.5% move? I mean, yeah, we could, but it's gonna have to unfold very quickly. We also have a market maker move of 0.4%. We can add that zero point 0.4 to the 1.5 and say that today's got a range, an expected movement range of 2%, meaning the S&P could move 2% and it wouldn't even be considered a big move. It wouldn't be considered an outsized move at all, or we wouldn't look at it and say, wow, that was an unusually large move. It wouldn't be an unusually large move. It would be large, be a big move, but we wouldn't consider it unusually large. We could look at it from another perspective too, because it's a 0 day. The options chain is going to show you the expiration period for today, April 22, 0 day. So it's telling us, yes, it's today's expected move. What's the expected move for today by the end of the day? $29.64. Well, if you take 29.64 and you add 17.94 to it, because that's the market maker move, that would give you your implied volatility expected move for the day. Basically $47, right? $48. If we get that close to 50, I might as well just say $50, right? That way you can do some easy math. If we're at 44.42 and you add $50 to that, that's 44.92. Subtract 50 from that, and that's 43.92. Easy numbers, right? No reason to stress. 43.92 puts us at the low of the range. Hey, that fits perfectly into what we were just talking about, right? A downside move being more likely to stay inside the box but tag the low end of it than to break out of the bottom of it and actually go somewhere. So that fits our description perfectly. The European Central Bank is putting out their numbers So we're very likely going to see this market start to rock and roll a little bit while I'm streaming. But there you go. Those numbers match up with the expected move. It's getting that validation, right? And when I talk about looking at support and resistance within the options chain, this is oftentimes what it's referring to. That market maker move combined with the expected move matches this support and resistance off the chart. Maybe that's just a coincidence, right? Yeah, maybe. I doubt it. So the downside expectation is yesterday's low, yesterday's open, and then yesterday's lowest point, 43.84 or 43.90, right around in that area. If we happen to get beyond that, then Tuesday's low will be the next line in the sand, and that is 43.75. For an upside break, there is the expectation that we just get a little bit of an upside move and not very much, that we mainly just maintain this range, but that we wick a little higher or grind a little higher and kind of ease into that 10-day point of control, because the 10-day point of control acts a little bit like a gravity point. It is not one, but it acts a little bit like that. If we have a large amount of volume there, and price tends to gravitate back to those volume nodes. So if we do happen to break beyond our own Globex high, it's very, very likely that we're going to go to the 10-day POC, 44.66. That's also Tuesday's high. It's not a coincidence because that's been the POC for a few days now. And when Tuesday got there, it gravitated right up to it and bounced right off of it. Confluence, right? So from our current location, kind of asking that question, how far is that? And would it leave us any room on the other side of that? We're looking at, zero point 0.5. We're basically flat now. 0.6, right? We give it a little wiggle room. That's still plenty of room. We could take another 1% beyond that, and it still would not be considered an outsized move. And that puts us up into the cog line at 45.11. Again, it matches our previous theory and analysis. We don't want to just randomly draw lines and hope it all works out, right? We want to find some way to identify confluence. 45.11 matches up with a volume profile node, but to get there, we would have to get through all of this trash, right? All of this trash from 44.80 down to 44.60. It's just a lot of old volume right there, right? The volume nodes, and it's still right at that point of control too. It's that same area. So if we got above that today, I would be surprised. And it would be very likely some form of news based, high impact, high velocity play where you just see these really large outsized candles, something that looks a lot like this candle, right? Some news came out, some econ came in and gave us just an absolutely significant monster candle in a very small time frame. When you get candles like that, it's a lot easier to break through areas like point of controls and pivot points. The good thing is it won't be subtle, right? It won't be like, hey, you think we're going to go up? Yeah, it'll be a rocket ship. Tick, Tran, AD, U-Vol, everything will be lit up, right? Like Christmas trees. It is worth coming out to the higher time frame, just kind of looking around and, asking where are we at? We're in the range. Now, I was looking at the FANG charts, and if you narrow this range down to just that right there, we had a nice rally off of the lows. We were all looking for a little bit of a pullback before looking at that continuation upward, and we didn't get that continuation upward. Instead, we faded back even more. Pullbacks are a particular thing. They should not pull back too far. What's too far? Well, I mean, 50% is kind of too far. This tool hides 50%. It doesn't do a really good job. There's another one called Quant Lines. It's a newer tool that Thinkorswim has. There's our 50% mark. We pulled back from those lows to the highs, right? The highs got us just barely above this previous price shelf. So high to low, measure that. Look at the pullback. The pullback actually came back 50%. If we were bullish, if the market was bullish, if everybody was happy and fuzzy and warm and exuberant, and people were taking profit, we would expect others to take their place, more willing participants to take that upside move. Where are they? Right? Just a little bit of context. Now, there's only 3 FANG names that have this pullback. The rest of the FANG names came all the way back down to the lows. So it's really important to grasp that. Here are the FANG names on the daily chart. Facebook, Apple, and Tesla have all pulled back in a good, clean, healthy pullback. The rest of the FANG names, Amazon, I mean, it could be argued, but mostly, I mean, it mostly came down. Most of the other FANG names made that trip all the way back down, or very close to all the way back down, way beyond half, right? So today's a little bit of an opportunity to see a continuation in Apple, Facebook, and Tesla, or to see Apple, Facebook, and Tesla begin to match their peers. Because one thing or the other is going to happen. Either the other names are going to start to rally back up and join Facebook, Apple, and Tesla, or Tesla's Apple and Facebook are going to continue to fall to match their peers. One way or the other. We don't know which way it's going to go, but it's definitely something you want to keep your eye on today and through the next week too, right? Because this is a daily chart, just a daily perspective. Absolutely worth taking a few moments, come out to the higher time frame and kind of get a look around and understand what's going on out there. These 8 markets are the marketplace, right? If these go down, we're all going down. And if these go up, then we're going up. All right, for the NASDAQ. While we're here, it's just worth going ahead and taking a look at the big picture. We're in the range. We've been in the range, and that pullback, that's a really big pullback. If this was strong and healthy and bullish, where is everybody? Where's all those bullish participants? We broke lower than 50%, although we did get back above it. We did. But just the fact that we even made it to the 50, let alone onto the other side of it and went below it, says a lot about the current run up. Most of the banks have said that this run up was nothing more than a bear market rally. And then when we began falling down, they said, well, that's the end of the bear market rally and we're heading down. So, I mean, so far they're right, right? If they were wrong, we would have pulled back just a little bit and then we would have continued that move to the upside like a trend does. And that's not what we have, right? We continue to sink to the downside. Maybe those banks actually got it right for once. I would be really shocked. They're usually wrong. The more they say we should sell, the more I buy. And the more they say we should buy, the more I sell. Because they're that wrong that often. So we are in a very tight, muted range now at this point for the week. Monday, Tuesday, Wednesday, and now Thursday. We've got our high and our low already set. We've re-tagged the upper edge now for the second time, right? We tagged it on 411. And then now, right? So let's look at that on a smaller time frame. Got it here on Tuesday. Got it there Wednesday afternoon. Got it here again last night in the Globex. Persistence beats resistance more often than not. But you got to also think about the liquidity for all those trapped traders, right? And I mean, you can take the perspective back here, but no, right? We're not going to do that. If you take these trapped traders and ask, are they still there? Well, the liquidity was still there Wednesday afternoon because we didn't pass through that area. So any trap traders, liquidity, we didn't get through that area. They are still there. Because if you think about, if they're short, their stops are above these highs. We haven't gone above those highs. We haven't triggered their stops. Until we pass through that zone and wipe out that liquidity, we're not going to get above that liquidity. Now, in the pre-market or in the Globex last night, we did get there, but that's overnight. We want to see it in the daytime. Technically speaking, we have taken a serious chunk out of the liquidity without bringing up a dome and looking at the volume on the dome or the resting orders on the dome. Can't really say that there's not orders left there at this point. Could be some really big orders still. If you were watching on Monday during the live stream in the futures when I was showing pulling and stacking and big orders and seeing orders on the dome, there very well could be a very large seller sitting here. And as price came up into that level and took out 2 or 3 or 400 of his contracts, if she was sitting there continuing to load more and more contracts onto that dome, and there was not enough buyers to work through her orders, and we faded back off again, there could still be a lot of contracts left to be traded up there. That big trader is, if there is a big trader, it's nothing here showing that that has been fulfilled. They're not done yet. So before we make it through that level, got to get rid of those orders, right? Looking at the volume profile on the 10-day, 14,465 is the point of control. Kind of asking that question, is it too far away? Could we actually get there today? We are down negligibly, right? A little more than a dime. That upside move is a 1.85% from our current location. That's well within range of the NASDAQ. We could make it that far. We are outside the value area low, and we're talking about aiming at the point of control. But we would first have to get through that lower value area, right? That's an area of resistance. But if we do get through the value area low, which is 14,266, then it puts on the table the idea that we could get to the POC. Just remember, it would be very bullish, right? Most of the day is done. We're on the back side of the slide for the day. The day is done. We're just on our way down, wrapping it up. When we look at the same situation as we did with the ES, asking that same scenario and kind of gaming it out, what's more likely and what could we do? 3 situations. We can stay range bound, break through the highs, or break through the lows. We're so far away from the lows at this point that it's much more likely that we could get to those lows, not necessarily break through those lows. And that would be a wrap, right? We'd be done for the day. So the idea that we break below 13.9 or 13.875 and actually get lower than that, it's on the table. Theoretically, it is possible, but not likely. So from that, we just throw that out the window, right? Saying going below yesterday's low, if we actually did start to do that, we could perform analysis at that point, but we would just wouldn't waste our time and instead focus on the next 2 scenarios. What's more likely? We stay in the range or we break out of the top. Considering that bullish move that we've seen with the test and the retest, it could be a topside breakout. But remember, it's all connected to that very long laundry list of economic events for today. That list is going to be way more valuable in trying to identify what this market could do than looking at any technical analysis with measurements and quadrants and any of that, right? So look at it from a different point of view. If the economic news gets us bullish, what would that bullish move look like? A break above the current high, a break above Tuesday's high, and a move towards the POC. If the economic news comes out and it's negative and puts us in a tailspin, what would that look like? Breaking back down below uh, the pivot point of 14,150, going towards the Globex high of 14,100, and then revisiting 1400. Missed that one by 25 points. Revisiting 1400. Right, so we've got our branches that we would hit all the way down, and we've got our top side targets if we happen to have got out of the top. Um, yeah, Santos, I have done a 10 video series on setting up Thinkorswim. I wasn't really trying to show people how to make it look exactly like mine, but instead I wanted to show people the steps that I took to make it look like mine so that you could decide for yourself how you wanted to do it. If you are in the after hours chat and you go to the pinned messages up at the top, I made 10 videos on Thinkorswim setups. And what I basically did is reset my entire Thinkorswim and then made 10 videos that walked through step by step how to get your Thinkorswim to look a lot like this with the bar across the top. Not my colors, right? The colors don't matter. It's easy to see, but like how to get those buttons across the top, and then how to use the flex grid and futures trader, active trader, pairs trader to your advantage, so you can have these preset, pre-made, ready to go charts that you can just hit the button and you get exactly what you want without having to go in every time and rebuild and get rid of indicators and bring in the ones you want. And what a mess. Then all you got to do is just teach yourself what the buttons go to. So, for an example, for me, when I go to pairs trader, it's always this grid. When I want to see the 9 grid sector, in my mind, I just think, oh, yeah, I got to go to the pairs trader tab because that's where my 9 sectors are at. If I want a 5-day, 5-minute chart with the volume profile per day, oh, yeah, that's the futures tab. It's always there. I want my weekly chart with the weekly expected move on it and an anchored volume profile or a VWAP. I go to my active trader because it's always there. But those videos will walk you through how to get to this point step by step. Really useful. Um, if you struggle with your analysis broker, which is what I use Thinkorswim for, analysis, I don't really trade on it very much. But if you struggle with your analysis broker, you're going to struggle with analysis. So what I would do is on the weekends, I would study Thinkorswim. I would go to the Thinkorswim YouTube pages. Um, I would read their articles, their blogs on the ticker tape. I would literally just study, how do I use Thinkorswim better? And then during the week, I would study trading because during the week the markets are open. There's actually something to look at, and that was the balance that I found in my life to get ahead quickly. It worked. I think I advanced pretty fast. All right, we're getting a retest in the ZB. That's the 30-year. You can see that same discussion that we were having on the NASDAQ about hitting the high and pulling back. Well, I mean, this is like knocking on the door, right? Persistence beats resistance. It's an interesting turn of phrase. I remember when I was newer, I used to have this idea that failure, right? 1, 2, 3, fail. And that is a trade. The 1, 2, 3 fail. Don't get me wrong. It's a fun trade. I love it. It works great. But 1, 2, 3 fail is not a liquidity discussion. Whereas when you have a market that set a peak or set a high and then we're coming back and retesting against that high, that's a liquidity discussion, right? Especially when it's a near term peak and we're not out on a daily chart and looking at something from 9 years ago that set a peak and we're coming back into that high. That's a completely different peak, right? And then that's not a liquidity issue. But we're looking at an intraday high yesterday in the bonds, and that was tested and then retested, and then we breached it and went through it. We've absorbed or taken out or wiped out a lot of that liquidity, but there's nothing that tells us from the candles that we've taken it all out. We would have to see the dome. We'd have to see if there's any orders left there, and how much, right? But in this case, persistence beating resistance is completely different than failing to get through it and having a 1, 2, 3 fail play. Watch for the bonds to break out. It's a significant situation that we're in. And a lot of times yesterday, I kept using the phrase that I'm kind of getting tired of using. It's not supposed to do that. I don't know how many times I said that yesterday, but we had stocks and bonds moving up at the same time significantly for long periods of time. And throughout history, there has been periods where stocks and bonds do move in the same direction, but it's not normal, right? It does happen. Hell, it happened yesterday a lot, but it's still not normal. And I spent a lot of time yesterday looking for them to decouple. I kept looking for the the end of it. And it finally happened right around 11 o'clock, where the bonds finally quit advancing and started to pull back while the S&P and the NASDAQ continued that advance to the upside. That decoupling was a very big part of my decision to go ahead and get long in a lot of other trades for the rest of the day, because it finally did break away. But man, it took half the day, right? The entire morning was shot looking for that convergence to decouple. Another decouple that we had to work on and we're still working on is the VIX dollar. So when the dollar is bullish, like the discussion we were having when the Asian market participants were piling into our dollar to get into our markets, that's not what we have right now. It's a different kind of bullish market where we see the dollar going up because there's really nowhere else for them to go, right? They're piling into the dollar. Well, when we see fear and greed being represented in the dollar, just like we would see it represented in the VIX, then we look at the dollar as a proxy of a fear gauge or a proxy volatility indicator, especially since our current VIX is not representing our current level of angst in the market, right? Everybody's gotten numb and they're just like, whatever, screw the fear. They're not re upping in their hedges. They're not ponying up all of that extra capital that it takes to trade into the VIX that way. And we're not seeing that VIX represent the fear that's out there, right? Just the situation that's going on. So these have been kind of worthless. The dollar's been a much more responsive representation of the volatility in the market right now. And when you see those two moving together, then you're getting every ounce of what's going on out there. But when they're decoupled, when they're divergent from each other, like they are right now, we see this big break this morning, and we do not see it in the VIX. So a little decouple there finally this morning. You just want to watch it through the day. You want to keep your eye on what's going on, asking that question. Are they coupled? Are they representing anything? Are they confirming our breakouts? Are we seeing this move with an expectation of a continuation? If we see the breakout in the S&P or a breakout in the NASDAQ and you do not see a movement in the dollar and the bonds, that breakout's very likely fake. It's not going to have much of a follow through. And maybe you're wrong, right? Maybe you sit on your hands and you say, nah, that's fake. It's not a real breakout. And it actually is a real breakout and you missed it because you sat on your hands. So what? If it's a real breakout, it means we're going into a trend. Catch that first pullback and run the trend and don't even be upset that you missed the breakout. Because at least that way you had full confirmation that it actually is a real breakout and you didn't get confirmation from the tools that we use to confirm. So, you made the better choice anyways. Who cares if you missed it? There's that old phrase that says, I would rather miss a good trade than take a bad trade. Right? Something to think about. We've been using the words a lot about the hedge trade, the gold trade. This is more of a global sentiment or a market hedge, not like individual people are running out there piling into the gold as some hedge against their portfolio protection or something like that. It's just the phrase that's being used. You can see it in the Wall Street Journal, Bloomberg. When they're talking about the hedge trade, they're talking more about hedging against inflation risks, not hedging against a downside move in the market in your portfolio. And the phrase that they've been using is the hedge trade, just like they're talking about, the oil and gold combined. They've been talking about it as the current trade on the war situation. Right? It's just a phrase that they use. But when talks are going good in this whole Ukraine Euro crisis, when talks are going good, you'll see the oil go down, you'll see the gold go down. And when you see any kind of phrases about, well, talks have stalled and, we're increasing attacks along whatever, you'll see these start to bid back up again. Right. So they're just a little bit of a perspective on that current market environment, on that current situation of what's going on out there. So it's worth watching because a lot of times we don't get the news right away, but we see the market right away. Seeing that dollar significantly starting to drop off or make uh, big sweeping moves to the upside. Want to just immediately start looking at the oil and asking if you're going to get the same thing. If you're not, then it's very likely decoupled. They're not signaling anything, any kind of heads up news in the market. And speaking of that kind of news too, you know, earlier in this war, the market was really responsive to any news that would come out. Now it's getting again more numb to the news that's coming out. You do see a little bit of whip or some volatility in there, but not even a third of what it had been when the conflict was more fresh in everybody's minds and it was a more fluid situation. So what do we got for the day, right? That really just kind of sums it up. What's our expectations for the day and where should we be putting our attention? It's a long weekend and we had a fairly significant move in the market yesterday. This is Shopify. We got this nice low down here. If we can get above, this is, think of this as a red to green, although yesterday was not a red day, right? But it was a day that left this big tail up here. If we can get a pre-market rally where we are going to open it near the high end of that wick, then we could have a really nice opportunity this morning in shop. Now, NVIDIA is a part of that FANG list with this little rope a dope where we went up and then we came right back down and all the way back down to these lows. When having a discussion with somebody yesterday, it wasn't in NVIDIA, but it was a market that was sitting at the lows. It was sitting near the lows of a pivot. And this is like a micro double bottom, or not even a micro because we're on a daily. It's a double bottom. And the comment from the person the other day, it wasn't on this, but they said, well, we're at those lows. Isn't this a good time to get in because we're at those lows? And he wanted to do a 1 year trade, like a leap. Don't make that fallacy. Don't make that mistake. Just because we're at the lows does not imply we're going to go up from here. We could stay here or we could go down from here. And his question was kind of like, well, how much lower could they actually go? Oh, they can go a lot lower. Whatever market you're looking at, if it's at $12, it could go to $6. That's a 50% drop. If it's at $100, it could go to $50. Again, a 50% drop. If it's a $2 stock and it goes to $1, it's a 50% drop. So don't just look at a market that's at its lows and say, well, this is a good time to buy. We're at the lows. It is a good time to buy because we're at the lows. But you now need a signal to buy it, right? Not just, well, we got a green day. So one thing you can use is higher highs and higher lows. At least one full set or one set, right? Not a full set, but one set. So if you're looking at it from a regular market perspective where you have a swing high and a swing low, that's what a market does to the upside, and that's what a market does to the downside, right? Swing high, swing low. And we got to try to find the midpoint or the mean in those so that we can kind of gauge where the tops are and where the bottoms are, or the turning points. Well, when we're at the lows of one of those and we start building a base along the bottoms and start working our way back up to get something that looks like that, then we need to see that higher high and that higher low start to come in. At least one higher high and one higher low. Now there's a OCR, higher high and higher low, or there's the swing high and swing low where you get a higher high and a higher low. What do we have right now? In an OCR, we only have a higher low. We don't have a higher high. We have an inside day on NVIDIA. We need to break out above Tuesday's level. That would give us a TRB, inside day breakout, and a move to the upside, right? And then at that point, we would have a higher high and a higher low on an OCR analysis. One candle reversal OCR. It's not just Nvidia, it's any market sitting at its highs, sitting at its lows, and you're thinking it's going to reverse here and start going in the other way. Wait for the reversal. You don't have to jump the gun. You can jump the gun. There's absolutely nothing wrong with it. The funny thing is about getting in along these lows. If you get in before you had confirmation, right? If you got in early, didn't wait for all of that information, you will make the meat of the move. You'll make the most money. But when you're wrong, you're going to lose more often than the other person. Now, I don't care about wins and losses. I honestly don't, because it's not about winning and losing. It's about how much money I make when I win and how little I lose when I'm wrong. Well, if you get in as soon as you can along those lows without waiting for any kind of confirmation, if it's wrong and it begins to lose, you can lose the least amount of all of the traders who are getting in, because if it breaks lower than it's supposed to go and you're already getting in near those lows, you were able to kill it and recognize quickly, oh, it wasn't supposed to do that. But if you wait for it to begin working its way back up and then you get in and you're still using that same low for your stop or for your exit to identify what wrong looks like, you have to wait for it to fall a lot farther. You have to lose more than the other investor just because you got in later. You'll also make less of the meat of the move. So if you're focused on winning versus losing, if that's your most important characteristic, you're going to want to wait and look for those validation signals. If you're more worried about making money, you're going to want to try to get in as soon as you can, as fast as you can along those lows before you even have any kind of trust or validation or signal that you should get in along those lows. The trades that feel the worst, the trades that make you think, I bet this is just absolutely wrong, those are often the ones that are going to pay you the best. And they're the ones that were right to begin with. Right. But waiting and waiting and waiting and getting all the confirmation signals and seeing all your indicators line up and waiting until the stars and the moon and the sun are all telling you to finally take the trade, you've missed 90% of the trade. And it's very likely you're getting in right before it begins mean reversion, turning back the other direction. And yes, even after it does print and confirm and validate that the reversal is there, it can still come back down and wipe you out, because the market moves not just based on these candle patterns, but on news and economics and everything else. So if we were to pull back farther in time and say we had set a low, we had rallied up off of that low, we had a nice clean pullback, and we started our move back up, there's a full set, right? We got a higher high and a higher low. We got a higher high and a argument could be made a higher low. Got a full set, a full signal there. This is implying that it's actually going to start making that move, but it didn't, right? Because candle patterns don't move the market. Candle patterns are our way of interpreting what is more likely to happen in the market. So it absolutely can do whatever the hell it wants, because price always can do whatever price wants to do. We're just using these to try to identify what's more likely to happen, and historically what has happened before. So double bottoms, one of the reasons that double bottoms are so good is because they're easy to see, but we can also state with quantitative fact what's more likely historically when we get a double bottom. How does it work out? Is it good or bad? And we can go back and answer those questions. It still doesn't say that the trade is going to work, just that it has a high probability outcome. All right. And that's what we want to focus on: high probability setups, really good risk to reward, and you take the trade. If it doesn't start doing what it's supposed to do, kill that sucker and move on with no grudge, no hard feelings, no getting mad and angry and beating yourself up because, oh, I suck. I took a losing trade. No, you don't suck. Everybody takes losing trades. If you did everything right and the trade still loses, there's absolutely nothing you could do about it. Move on. But instead, what I see is everybody gets upset. They start beating themselves up and they start saying, oh, I got to readjust my system, my strategy. I took a losing trade, and you'd spend the next 3 months rewriting the entire system, trying to figure out a whole new way to do something, breaking something that was never broken. Just had a losing trade. So looking at the sectors this morning, the S&P old school legacy sectors, we got cloud computing, technology, semiconductors, jets. Had a really nice carryover in the airlines yesterday after a good earnings report. It kind of bled into uh, the other names in the sector. Small caps are really worth looking into a lot more recently. And then the Qs are basically flat. We start getting into what's down this morning. Energy, the devil's metal, another energy, retail, emerging markets. Now, emerging markets is what we use for global risk on, risk off sentiment. And seeing that down kind of puts a little bit of a damper on our bullish exuberance this morning. EEM and junk are two that are really useful to look at in the morning, kind of get that global sentiment. But those legacy sectors, they don't cover the newer things that we'd really want to look at. Say, breaking down the pot market better, or the EV market, or crypto. So we make our own ETFs for that. So looking at the crypto here, we can see that crypto's looking, relatively well. There's a couple of names in there that are a little weak. For the EV market, mostly flat to negative, not looking very good in there. And then for the pot stocks. So with energy being down this morning, it's going to be my focus today. And the finance, because banks are kicking off everything. Pot stocks are mostly looking pretty good. There's a couple of names in there that are down to weak. SNDL, Tilray, a couple of Cron, a couple of more well-known names. But I think it's going to be energy and finance for me. It is a 0 day today, again, like yesterday. Um, we're running contrary plays yesterday just because you don't have to babysit them as much. But yesterday was one of those rare days where you get a market that has run really far in one direction, and it's midday and you think, oh, there's no way it can run even farther now, and then it just keeps doing it, and then it pulls back and you think, yep, that's it, it finally did it, and then it runs more, and then it runs more, and then it runs more. They don't happen that way very often. Most of the time when we've set that high after a good run through the morning, that's it, and we usually just kind of range around, or we get a market reversal. Yesterday was one of those rare days, but it shouldn't have caught you off sides. And like I threw in the chat yesterday, I followed this through, posting ahead of the move through the whole afternoon yesterday, and was easily able to articulate to others, we're not done yet. This is just a fake reversal. We're still going up. The move is not done, and ran this thing all the way through the day. Even had a short on where I got in. I think the short was right here, but it might have been right here. Either one of those. And still got money out of that short because my break even was above all of that. Right. So it's not like we can't run contrary in a day like that. We can still run that downside move. Just got to give it enough room for us to be right. And I got out of my trade right around in here so that I didn't get ran over. And those were just the 0 days that were out of the money that gave this thing a little bit of room, just making a little bit of, little bit of money at a time. It's unlikely that we'll see 2 days in a row of the same hard grind with a pause and then another grind and then a pause and another grind and a pause. It's very unlikely to be that kind of day to day. Go through and rewatch everything we went through in the S&P through the ES market, and you'll have a pretty good idea of how to handle the S&P. That's it for me, guys. I'm going to get off of here. Have a good day. Be careful and enjoy your weekend. We'll see y'all back on Monday.